Financial Times reports that U.S. money market funds and banks are stockpiling cash in the event that Congress fails to raise the debt ceiling. Funds are preparing in case market volatility spikes as compared to the increase in redemptions. And they're simply worried of the impact that the debt downgrade could have on the short-term repo market. Joining us now is our guest host for the next hour. He's John Authers, head of the Lex column at the FT. John, great to see you. So you heard from S&P. What do investors need to make of the ratings agencies when they say, and I'm a lady here, darned if you do and darned if you don't?
Well,
it's a pretty tough conundrum.
Well, I mean, obviously the rating agencies have very much more of a credibility problem than they did 3 or 4 years ago because they made a historic bad call on US structured credit. So far, their record on sovereign credit is very much more respectable. They will, in rather wounded terms, point out that they started the process of downgrading peripheral European credit some years ago, before it was particularly on the market radar. In terms of where we are now, I would still agree with everybody else that it has to be, on balance, unlikely that we actually get to a technical default. I still cannot quite believe that Congress would be that stupid. When it comes, however, to the question of whether there is a downgrade from AAA, I suspect Mr. Beers from S&P there was being somewhat diplomatic. I think the chances of a downgrade from AAA must be quite a bit more than 50% at this point, because even if we have a short-term deal, then that's plainly going to lead to a downgrade. If we get one of these suggestions that we don't get that we have another vote in a matter of months. But apart from that, any kind of measure that will require difficult austerity cuts or raising of taxes will, in the short term, be bad for economic activity and be likely to prompt a downgrade of the rating. So it seems to me quite likely, more than 50% likely, that we will get a downgrade. The thing is, as we were talking about with Asian currencies, where else is there to go? You've seen an effect on the foreign exchange market. Very few other markets would you see any noticeable, visible symptoms of concern. It's only in the foreign exchange, where you absolutely have to go somewhere, that you can really see any great worry so far about the debt ceiling.
But you're not really seeing that. I mean, look at the euro dollar, look at the dollar Swiss franc. There's no panic selling there. Why so much investor calm if you look at these major currency crosses?
You've got in any foreign exchange, you've got to go somewhere else. Sterling has gained something like 3 or 4% against the dollar in the last few days, despite truly awful economic figures coming out of the UK, for example. Similarly, the Eurozone is subject to very great concern and very great risks, and is still somehow or other managed to gain really quite sharply in the last week. Again, that's a sign of the US debt ceiling. If you take a look at something like the Swiss franc, or, as you were saying earlier, the Japanese yen, which is now almost as strong as it was in those perverse days after the tsunami, on those currency crosses, I think you do see some very real concern. If the word is panic, no, well, all of us financial journalists have to be careful about using that word. No, there isn't any panic out there yet.
Okay, John, hi, this is Christine. Let's go back to the ratings downgrade. If we do get that downgrade, essentially to me that would mean interest costs would go up. It would be more expensive for the U.S. to service its debt. What are the repercussions on the U.S. economy?
The repercussions are plainly negative. There's no point trying to sugarcoat that. The question is more exactly how much rates would go up. The Lex column has an analysis of this in this morning's paper. It's just so difficult at the moment. Bonds that are either Treasury bonds or ultimately guaranteed by the Treasury make up more than 50%. I think the number is 53% of the entire global stock of AAA rated credit. It's difficult to see where all of that money is going to go in a hurry. The number of places, the number of funds that are truly mandated that they cannot go anywhere other than AAA is smaller than you might think. I mean, it became very important during the structured credit era. But plenty of US money market funds, for example, are allowed to continue to hold US Treasury AA rated paper. Sorry.
I'm just thinking, and given that you're going to see haircuts on Treasuries taken as collateral, then does that mean that we're looking at the potential for a credit crunch?
Oh, we're certainly looking at the potential for a credit crunch, and if we get a technical default, or if we get into this sort of really scary scenarios of Tim Geithner working out what he's going to pay and what he doesn't pay, and one possibility is that states go unpaid, and then suddenly there's a default by a state or a municipality that nobody was thinking of. I mean, the risk if we actually have a default, even for a matter of days, of a Lehman-like, nobody knows which Treasury-backed collateral is good, so everything is treated as though it isn't good collateral, and we get back into that same horrific state of affairs we had post-Lehman. That's a very real risk. It's just, it still seems, one hopes, unlikely that Congress would be that stupid. Maybe I shouldn't be saying that, but that remains our one hope, is that they can't really be that stupid, can they?
Crazier things have happened, my friend. John Author sticks around for the entire hour, head of the Lex column at the FT. Any questions for John? I think he will take them. He's a sport.